yeah, let's get started. I hope everyone can hear okay. Obviously, the other day I did the kind of webinar on the extra bond, so probably don't need to spend too much time kind of going into the actual kind of product itself, although happy to answer any questions on that if people do have specific things. I guess just hit them in the little chat section at the bottom of this. So if you look on the bottom toolbar of Zoom, you've got the chat, click on there and just type any questions in, and we'll try and make sure that we get through them all by the end of it. But the main reason for this call was really Paul has obviously closed two reasonably substantial companies using the extra bond, and has described it as a bit of a game changer when it comes to closing deals. So we thought it'd be a great idea to share the best practice and experiences that he's had out there positioning this, just so that we can all hopefully benefit from that sort of insight into how to present this in the best way to get more deals done, really. So yeah, Paul, anything, or what are your thoughts and advice on that?
Yeah, so I've actually just put a few slides together, which I'll share on the screen if you like, and I'll just sort of take through sort of, I guess, how I've approached it with these deals, and I guess what it's doing in terms of opening up the door for other opportunities. So let me just share the screen. Can we see that?
Yep.
Yeah, cool. So I guess typically the sort of deals that I'm sourcing, I'm generally speaking to two types of business owners. I'm either speaking to those that are seeking investment, so clearly they're perfect for an agglomeration pitch, or we're talking to business owners that want to exit. And I guess in a traditional agglomeration, an exit doesn't really work, because the whole pitch is really about coming on this journey with us and building together and using MBH as a platform for them to do that. And if they just want a big fat check for cash to walk off into the sunset and do something else, then they wouldn't typically fit that agglomeration model. But I guess the two deals I've brought in, one was a business that I was already involved in, and I see it as an opportunity to use MBH to go out and grow and build a group in the leisure sector. And then the other business was a sort of cross between the two, in that there was 5 shareholders, 4 exiting, but one was very much keen to be involved in the future and build a bigger business. So I guess they're the sorts of types of business owners that I'm seeing, and the sort of process that I follow in terms of sort of bringing them towards some sort of deal. I'll just walk you through very quickly the process, and then I'll sort of talk about how I sort of introduce the bonds into the conversation as a way to get the deal done. So typically I'll start off with a brief introduction call, and really in that call they get to know me, I get to know them. I'm trying to understand what the motivations are. So are they exiting? If they are, I guess what's important from my point of view, if we're going to use the bonds to bring them into MBH, is we want to understand who's going to run this business if it's not the business owner that's exiting. So if you take the example, there's 5 shareholders, 4 have exited, one has taken the step up to become the MD, and she's going to be running that business day to day. And then I'm really looking for sort of outlining what we're trying to do. So the way that I sort of introduce the whole model is we're looking to acquire a platform business in their sector, and we're using that as a platform to grow by way of acquisition. So if you take Logistica, for example, they're a social care training company, and they see a big opportunity in the hospitality industry for what they do. So under normal circumstances, they would go out and try and win contracts in the hospitality sector, but by being part of MBH, we can now go out and buy a hospitality and training company, and we can probably get to where we want to get to a lot quicker through acquisition rather than doing it organically. If they're looking to exit, then we'll talk a lot about protecting their legacy. So coming into a larger group, there's opportunities to grow and expand. So that gives opportunities for their people. So it's all about investing in their people, their processes, building from what they've created, and I guess almost positioning ourselves as as a safe pair of hands. What I then sort of get into is then a sort of very basic conversation around deal structure. So if they're looking to exit, we can talk about, we can make a really clean, easy deal. So no lengthy deferred or earn out consideration. We can put some consideration on the table. We can acquire the business and then take it off your hands and go forward. But if they're looking to come on this journey with us, then the way I sort of position the bonds is that we can actually give them something off the table now, but then they can build a much greater wealth with shares in the PLC. And then I'll close them after that with the next steps, which is really, you know, I sort of like to have the financial conversation at the outset. I think what I say to people is that there's many things that go into a deal, and sometimes, you know, money isn't the be all and end all, but clearly the financial side of any deal is quite important. So we like to have the financial conversation early on in the process rather than at the end, because we can risk having lots of nice conversations and getting to know each other. But if we were never aligned on the whole financial side and the deal structure, then
I'm on a webinar.
There's little point in terms of.
I'll speak to you later when I'm not on the phone.
In wasting time in a process. So I'll close them for an NDA, get some financials, we'll get the financials, and then on my second call, that's when I have that financial conversation and then really get into the detail of how the bonds work and how we can use them to put a deal together, regardless of whether they're looking to exit or whether they're looking to come on this journey with us. So, next slide. So in terms of how I sort of introduce the bond to the business owner, obviously I don't do this until I've got them aligned on value and I've got them aligned on, you know, trying to do a deal with me. But I'll say that we're involved in a diversified investment company, which is a listed company on a European exchange, and I'll explain that, you know, there's 10 companies inside MBH. So the way that the deal would work is that the MBH would issue a corporate bond to the value of whatever we've come up with, and then I'll explain how the bond works. So the bond attracts an interest rate of, you know, somewhere between 2 and 5%, and it matures in 5 years' time. And then I'll explain that with the way that interest rates are at the moment, actually it's a pretty good investment, because interest rates in the UK are obviously less than 1%, and some parts of Europe it's negative. So if they could have a bond that gives them a 5% coupon, then it's a pretty good investment. So if you issued, say, £1 million bond, well, over 5 years at 5%, it's worth 1.25 million. But and this for me is sort of the game changer part of this, is if they actually want cash, or they want some cash, then they can actually sell the bond. And the sorts of people that buy these bonds are investment companies. And my understanding is that MBH has onboarded several sort of investment companies that will buy these bonds. And there's this period of what's called seasoning. So it probably works a little bit like how you build a credit rating. So on the day that the bond is issued, there's no track record to that bond. But as time ticks on, and as MBH pays those interest payments every 6 months, the bond becomes more seasoned. So in order to turn it into cash, you would expect to discount the bond somewhere between 15 and 30%. To sell the bond to one of these investment companies. So if you use that £1 million bond, for example, you could sell that maybe for 700 grand, and the investment company that will buy that bond will ultimately earn the interest, and obviously they'll show a profit when they acquire the bond, because if they buy for 700 over 5 years, that bond's worth 1.25. So it's a pretty good return from an investor's point of view, but it means that they can turn some of these bonds into cash. And I guess they've got a few different options. They could sell them all on the day that they do the deal and turn it all into cash, but because the bond isn't seasoned, then they're more than likely going to have to offer a pretty large discount to get that bond cash. But if they were looking to just sell their company and take the money and then go and reinvest it in something else, then they might want to consider actually it would be better to just probably keep the bond, or maybe just cash in some of them to get some cash to go and buy their boat or property or pay off the mortgage or whatever it is that they're going to do with the money, but then leave some of those in as bonds and then sell them off gradually. And it just means that they won't have to discount them maybe to the level of 30%, and you know, maybe in 12 or 18 months time it might be single digit single digit. So I guess the way the pitch works is that, you know, if you want to exit, we can give you a bond, we can give you a guaranteed value. You know, it's issued by a PLC that's got 10 cash generative, very profitable companies. So if you like, it, you know, MBH are good for the money to pay that in 5 years' time. Or if you want to take some cash off the table, then you can sell these bonds to investment buyers and actually receive the cash rather than keep the bond, or do a mixture of those things. So it's great for people that want to exit, assuming that the business comes with somebody that's capable to run it and grow it and be part of MBH and take it to the next level. But equally, if you've got an ambitious business owner that wants to grow, then, you know, it gives them some cash off the table now, and then they can earn shares in the PLC as time goes on. So I think there's some really great benefits. You know, clearly to the business owner, it gives them a clean exit, whether that be now or in 4 or 5 years' time, if they're coming on this journey with us, because they'll not just take cash off the table or a bond now, but they'll also earn bonus shares along the way. And I think from, you know, if they want to come on this journey with us, then, you know, you know, the reason I brought Robinsons into MBH is I believe it's a great platform to really go out there and take advantage of those opportunities. So I think there's huge benefits to a business owner. In terms of what's in it for people in the Harbour Club, well, MBH will pay an introduction fee for any businesses that come in, and if you're bringing a company in, then MBH will issue you with bonus shares for every pound of EBIT growth that you create, at 3 times that level. So if you look at Logistica, for example, we're forecasting that we'll increase the EBIT within the business by 500k, which would give us about 1.5 million of bonus shares. And what I'm doing is I'm sharing those bonus shares with the senior team within Logistica. So not only am I earning some future bonus shares as we grow the profitability of the business, but we're also giving the key people within the business, including the shareholder that obviously has stayed part of the business and is going to run it. It gives them a real vested interest in the future. So there's, you know, really can help build your own wealth pot in terms of trying to do these sorts of deals. So the sort of companies that I'm targeting are, you know, really good, profitable, quality companies looking in any sector, but it's ideal if they already complement one of the businesses inside MBH. So inside at the moment, we have verticals for construction, education and training, health and the leisure industry. And I'm looking really for companies with more than 500k's worth of EBIT, unless it's more of a tactical sort of acquisition where we could maybe bolt it onto one of the existing businesses inside the group. So, you know, looking for lower profits is okay, but I would sort of position it that I'd really be looking for a good home for that business, or there would be some real compelling reason why bringing that in will benefit other businesses in the group. So that's just a very quick summary of sort of how I sort of approach it and the sort of opportunities for me. I think what's really good about it is if you're into doing like LBO type deals, for me, this almost replaces the LBO. So I did quite a lot of LBO deals last year. And I think the problem with LBOs is that, you know, you're putting a load of debt into the business, and if something bad happens, like COVID-19, for example, you can end up in a fairly precarious position. And there's also usually lots of controls and stuff that you need to deal with in terms of you can't do this, you can't do that. You've got covenants that you've got to comply with the lender. But if we're using a bond as a way to do the deal, then there's no debt in the target business. So it means it can freely trade. There's no restrictions that any debt might bring into this business. And almost for me, this has completely changed my thinking of, I'm not going to do LBOs anymore. Let's use bonds as a way to get our hands on really good, profitable companies that can, you know, hopefully continue to grow MBH. So yeah, hopefully that just sort of gives a quick summary. I don't know if anybody's got any questions or.
Paul, have you done part share and part bond deals then? Have you done a mixture of the two, or were they fully bond? Or
Yeah, so with Robinsons and Logistica, it was all bonds as the initial consideration, and then into the future there's bonus shares. So yeah, it's both, but there wasn't any shares on the table at the outset. But I think I think I'm right in thinking, Jeremy, that we can do a mixture of bonds and shares, but those two were just bonds.
For the consideration part. Yeah. Okay. And did they get their head around them quite easily?
Yeah, I guess that's always the challenging bit, and it depends on the motivation. So I would say that it's really important to actually get a really good relationship and rapport, because once you've got that, you've hopefully then got their trust, so that when you start talking about bonds, and it might all seem a little bit complicated to the average business owner, I think if you've got that relationship and rapport, it's much easier to be able to overcome any objections. And I think what a lot of business owners typically are looking for when they're looking to exit is that they expect a big check for all of the money, and off they go and do something else. But I think we all know that the reality of the way the world is there isn't a queue of people with big fat checkbooks buying businesses for cash. But I think obviously this gives you, using the bond and making that analogy between cash, and you can turn it into cash, and explaining the mechanisms of how that works. Obviously they need to get their head around it, and it can be sometimes quite challenging, but I think the key to it really is around getting that relationship.
Good morning, Paul.
Mark?
Quick question. The bonds, obviously they can be used as collateral as well instead of cashing them in. So if somebody wanted to go secure an asset on a private basis, they could give that to a broker and use it as collateral.
Don't think so, can they, Jeremy? I don't think.
Yeah, I mean, look, theoretically, corporate bonds can be used as collateral, but again, generally, it comes down to things like having a credit rating on them and having that track record, the seasoning. And obviously, we're still seen as being a very small company, so it's something that could possibly happen in time, but probably not. Private lenders, yes, possibly, but institutional lenders at this point probably wouldn't look at the MBH bond in that way at the moment. And sorry, for some reason I had a big technical failure here. My Zoom just froze, so I missed the whole last part of Paul's presentation. But as somebody asked the obvious, what are the common objections question? What are the things most people sort of push back on in terms of not wanting them, for example?
Yeah, I suppose that will probably be the first question a potential seller would be asking, purely just to de-risk themselves.
Yeah, I mean, look, there's a few things. I mean, one interesting thing is Lloyd's of London offer credit insurance. I mean, I'm sure quite a few other people do as well, but we've looked at Lloyd's of London for credit insurance, and you can actually credit insure the bond. The good thing about that is that insurance companies don't like insuring risks that they have to pay out on. So that would suggest that they're fairly confident in in the recovery of the amount. The cost of it is actually 3% of the sum insured per year. So if you have a 5% bond, it would take your 5% down to 2%. Obviously, if you have a 2% bond, you're paying more to insure it than you're receiving in income, but you're fully insured, 100% at the end of the lifetime. So just looking at it personally, it probably isn't something that I would do to insure it. But it, like I say, it's encouraging that it could be insured, because that normally suggests that there's not that much of a risk there, or the insurance company wouldn't provide the service. I mean, when people talk about de-risking, I mean, obviously, if you have more than 50,000 euros in a bank account, or 100,000 euros, I think it is now, in a bank account, and the bank fails, you obviously lose all the money in excess of 100,000 euros. And at the moment, they're paying you almost nothing in interest on that money while it's sitting there. And mortgage rates now are so low. I mean, I've just cleared a mortgage that I had on a property in the UK, and I think it was at about 1.9% or something like that was the interest rate on it. So it's almost, again, there's so many things that you could use that money for instead, that would generate more than 1.9% percent, that you're almost it's almost worth just leaving debt like that, lying sitting there. So the most common things I guess that people want to do with the money are tuck a bit away to generate some income, or pay off a mortgage, are kind of the first two go-to things that people plan to do. And obviously, if they're going to receive interest on the bond while they're waiting, that's quite a strong alternative. And I guess a lot of small business deals are done using vendor finance. And so vendor finance is just where you agree to pay the person some money over a period of time for buying their business. And obviously that's very much, you run the business, you take money out of their business and give it back to them over a period of time to buy the business. It's a fairly, obvious kind of structure, and people will often accept a bit of that, but not a lot of that. This is quite different in terms of it's not just their business that's contributing to the buying back of the bond. It's a collection of businesses that are collectively enhancing their own value through acquiring that business, but then also collectively responsible for buying it back. So that's that gives a lot more kind of security, if you like, over the product from the vendor's perspective. It's also a regulated, it's been approved by the Dublin Stock Exchange for investors, so it's gone through that process of having a prospectus issued and all of that stuff. So I think that puts it in a slightly better position. And of course, it's publicly traded, so there is this ability to sell them. And like Paul says, seasoning is everything. The closer you get to a bond expiring and giving you cash, the more valuable it becomes, and the more reliable the bond is seen to be in terms of making payments and things like that, the more valuable it becomes. And I mean, there's quite a big, if you look at JNK, which is the ETF for high yield bonds, I think the average yield of high yield corporate debt in the US at the moment is about 5%, if you look at the ETF's performance. But if you look at the price of some of the bonds that expire in the next few months, they trade at well above par. So a bond par is 100, basically, like 100%. So it's a pound for pound. If you look at stuff that's expiring this year, it'll be selling at 102, 103, 104, these kind of prices, because the cash comes back very quick and you can capture that yield in the short term. So there's an appetite to buy that short dated debt, because you're only in it for a short space of time, and then you get the cash back. So I think it's an interesting instrument. It has lots of advantages in that respect.
Yeah, I think one of the biggest objections is, particularly for those that want cash, is they're concerned about, are they going to be able to turn it into cash? And I think, as Jeremy says, it's really trying to actually turn it on its head. What do they actually want the cash for? Because actually, it would be better to just keep this and earn the 5%. But if they really do want the cash, it's there are buyers out there for them, and it's just a different mechanism. I mean, obviously, if you've got a loan shark or credit card debt or something like that, then I could imagine it's probably worth cashing some in to pay it off, rather than being murdered in the night. We're literally just about to find out the mechanics of selling the bonds, because obviously there's a couple of the people that have just received them that would like to cash a small number in pretty much straight away. So we've already kind of had the conversations about onboarding them with with all these small funds that will buy them. But until we actually have a bond delivered physically in a bank account, we can't progress those conversations any further. They have to have visibility of the bonds being delivered. At the moment, if you go onto the Irish Stock Exchange, you can't actually see any bonds in issue. They're in that limbo from being approved to being in the account. I just chased the bank today, actually, and they said the value date is tomorrow. So looks like we might have, well, when I'm in midair and I can't check, they should arrive. So hopefully I'll either land to very disappointing news or very good news. So there we go. But yeah, basically once they're in
an account, we can send all the details over to these funds and go through the onboarding process. So there's some pretty big platforms in the UK that you have to go through like a due diligence process with, that then allow all of the pension providers to buy them. So, you know, if you have a SIP or a SAS or an ISA or any of these self-invested pension type or tax-free savings schemes, normally, if they're self-invested, you can normally go onto like an online platform and they have a list of products you can buy. So, you know, there's a list of bonds and a list of equities that you're allowed to purchase through your SAP or your SIS or your SAS or your ISA. So basically we need to get it added to all of those platforms, which apparently is a relatively quick and straightforward process if you're you know, fully listed, fully tradable bond, but I've never done it before, so we'll have to see how that goes.
Jeremy, I presume that if you were approached by a seller and you offered him bonds as a deposit, if you wanted to cash in any of those funds, you could potentially negate that by adding it to the deferral. So if it's going to cost 15 to 30% and he wants 200K out of $1 million in cash right now, you can at least give that back to him instead of parting with that right now, I suppose.
Yeah, so interestingly, one of the things we discussed internally was about, and I think we might have discussed this with Logistica, was having a what's called a repo program. So a repo program is where MBH itself has the right to buy its own bonds back at a discount. Because obviously, if MBH buys its own bonds back at a discount, it's kind of like some magical financial engineering. Because what happens is you buy a company, the full value of that company sits on the balance sheet as acquisition goodwill, and then you get to buy some of the consideration back at say 90 cents on the dollar, and effectively that extra 10 cents goes straight to profit. So it makes the profit of the group higher, which makes the value of the group higher. And you extinguish debt at the same time because you own your own debt. So in the balance sheet, you know, the long-term liabilities are matched by an asset, which is the asset is greater in value than the liability. So so there's a bit of sort of financial engineering wizardry that we could do with a repo program, which is relatively interesting. But as you rightly point out, Mark, if you're going to do that, why not just do a proportion of the deal as a sort of unlisted note? So let's say they wanted to take, you know, 25% of it in cash and 75% of it in the traditional bond. You could just issue the traditional bonds for 75% of it, and the other 25% could just be a note that the company issues that it buys back. But yeah, we've discussed that kind of internally. I don't know if we came to any conclusion actually, but that's another tool we could have in the toolbox, is to just do some traditional vendor finance with alongside a bond. But yeah, I quite like the bond because it's kind of a it's kind of a currency. It's delivered to their bank account. They can see it sitting there in the bank account. It's an interesting instrument from that perspective.
A question I have regarding what you were saying, Paul, about the people wanting some element of cash. The answer I always get when I ask why is I want to pay my mortgage off. I want to pay some property loan off. Is there a way that the bond could be leveraged against that to make it easier?
No, I don't believe so. I think, again, like Jeremy said, I think that in time, when the bonds become seasoned, then, you know, like for example, using Julius Baer to sort of leverage assets and stuff, you know, Lombard lending and all that sort of stuff, the bonds can't be, but maybe one day there, you know, it might be an option, but I don't believe right now there's any way of leveraging other than finding a private investor that might be willing to, you know, swap.
Yeah, I think there's three options for somebody with a mortgage. You either hold the bond and use the interest payments to pay your mortgage, because the interest on the bond should be higher than the mortgage rate. You sell some and take a little bit of a bath, you know, because you're going to have to take a discount to sell some earlier and use that to pay off the mortgage. Yeah, I guess that's the two options, isn't it? Take a bit of a bath on some in the short term to pay it off quicker, or to just use the interest payments to cover cover the mortgage payments.
Okay, thank you.
Yeah, I've got a question. What denominations are the bonds in? Because, if someone wants, like that last example, 200 grand cash, surely they can't just cash in a small amount of the bond. The bond will be of a particular size, won't it?
They're 100 grand minimum and then 1,000 increments. So both in the pound and the euros. So the euros is 100,000 euros and the pounds are 100,000 pounds. And bonds are a bit weird like this. So I've got quite a few corporate bonds from other providers in my private banking account, and you can basically buy any amount you want. I mean, with normal corporate bonds, they're actually normally 200,000 minimum, but we've got 100. I think 100 is the kind of legal minimum to be a corporate bond, because it's basically it's aimed to put off retail investors. And so by making it expensive enough, then you're not attractive to retail investors, therefore they're less likely to buy them. But basically with the corporate ones I have, they're mostly 200 grand minimum, but you can buy 201,000 or 202,000 or 250,000 or 257,000. But then when you're selling them, you have to sell 200,000 as a minimum. So you can't sell 200,000 and be left with 57,000, for example, because that's a computer says no. So it's a bit weird. So generally people don't tend to trade in odd numbers of them. They tend to trade them in lots of, in this case 100,000. But theoretically somebody can buy anything above 100,000, and we can supply those. So when they get delivered, they actually get delivered as one lump. They show up as one line on the on your bank account. So it's not like shares where it will say 50,000 shares at X price equals this. It will just say MBH, the ISIN number for that bond issue, because each time we do a new issue, it has a new start date. So obviously the start date dictates when the coupon dates are. It has a currency and an interest rate, and so all of that is unique to that ISIN. So that ISIN number will appear, and then it will just be an amount like 8 million or 12 million euros or pounds or whatever it is next to it. But then you can sell 100,000 of that or 200,000 of it, or how whatever bits you want, as long as they're more than 100,000. So yeah, it behaves a little bit differently in your portfolio to shares. They are a little bit strange bonds. I've never really understood them. And also, although they're on a market, you can see them on an exchange, just like you can with a stock. You have a bid and an ask. Whenever you trade them, it's always what they call OTC, over the counter. So the trades are matched off market. So you don't need the market to be open to match a trade with somebody. Yeah, it's all done, OTC as they call it, over the counter. So the way you trade them is also a little bit different.
Okay, thanks. But also, if you wanted to divide them up, if you're doing it together with someone else, and it was you need to divide up 100, you need consensus between the two, what you're going to do, whether you're going to hold them or sell them, presumably.
Well, yeah, I mean, I guess we haven't had that problem yet. I mean, if it's let's say there's two of you and you've sold a business and it comes to an odd number, then let's say, I mean, actually we have a shareholder in one of the company, I won't mention them, but one of the companies who's going to receive 685,000 in shares. So effectively we issue them 500,000 plus 185,000, and then they've got 685,000. Because we can't issue 600 and then 85, because you have to do them as a minimum of 100. So they get two deliveries effectively to their account to get to their 685,000.
Okay, thanks.
What is the maximum bond you're willing to issue per entity? Let's say are you limiting it to net asset value or fire sale value, or are you including an EBITDA portion there as well?
Yeah, so I mean, obviously, the CFO, Victor, always takes a look at, obviously, the affordability of the bond. So he tries to drill down to a point where the business that's coming in on its own could afford to support the bond, both in terms of interest payments and long-term value. And then whilst it does sit in the whole group, at least companies coming in wouldn't be a burden to the rest of the group. So that's the sort of rudimentary methodology. And then obviously as a group, we want to ensure that, we're not doing, at the moment, we're doing deals all in bonds because the share price wouldn't allow us to grow our earnings per share. So 100% bond acquisitions makes a lot of sense to us right now. But as soon as the share price gets up a bit more, it would make, we really want to get to a position where you're doing 50% shares and 50% bonds for a number of reasons. One is it helps with the accretive nature. You get the earnings per share growth. Also helps with buy-in, getting people, who are in the business who have a vested interest in the share price performance as well. So everybody aligned on share price performance. So yeah, I think in future, or the way I would probably see it in the future, is that older members of companies that are retiring would take bonds, and the younger, more hungry ones would stay in and take shares. And in fact, that was probably one of the genesis points for this. Was a couple of companies that we were looking at. One of them is still in DD actually, but we started talking to them about a year ago, and they're 70% owned by 70-plus-year-old retiring people, and 30% owned by the management team that have already been running the business for 10 years. So they've and the conversation that kind of constantly goes on is, how are the young people going to buy out the old people? Are they going to borrow money from the bank? Are they going to try and get external investors to come in to do that? And neither of those options have ever seemed really appealing to them. Whereas coming and joining MBH, where the old people can walk off with the bonds and the young people can take the shares and the bonus shares going forwards, just seems like the holy grail of everything they've been looking for the last 3 or 4 years, in how they transition away from that management team. And actually, the other interesting thing is that management team are all still paid members of the board at the moment. So as soon as those old people leave the board, it adds about another $500,000 to their net profit. So they straight away get the bonus shares the next year, just because they've managed to get the old generation out of the business. So, and I think we'll see that. I mean, that must be repeated everywhere in the country. I mean, that must be such a common challenge right now. And by the way, that business is 20 million revenue, 2.5 million profit, 30-year-old company, blue chip clients, very well respected. So, that I'm sure is repeated again and again and again.
Yeah. Okay. Thanks.
Cool. Well, if there's no more questions, I think we can leave it there. Any final thoughts from anyone?
I just think that's been really useful. Thank you. Really good. Thanks.
A great concept. So it's definitely, I think, going to change the sort of platform. So I'm chatting to a couple of companies already, and I can see how it will intertwine already. Definitely alleviate the pressure on going to banks for LBOs or anything like that. So yeah, great, thanks.
I think it's great. It's great they can see it in their bank account as well, Jeremy, because it seems real then, doesn't it?
Yeah.
Deferred consideration. It's trust, isn't it?
Yeah. Whereas this, it's sitting in their bank account, and it's
not ours. Yeah.
It feels better.
Brilliant.
Awesome. Right. Well, hey, look, thanks everyone for your time, and especially obviously thanks to Paul for his experiences, because he's absolutely smashing it at the moment with the deal flow. And of course, if we can replicate that everywhere, then we really will be flying. So thanks Paul, and thanks everybody for taking the time out. And I'll get this posted in the Harbour Club app as well, just so that hopefully we can spread the word a little bit further.
All right, guys.
Cheers.
Thank you.
Thank you.
Bye.
Take care.
Bye.
See you soon. Bye-bye.
Thanks very much, Jeremy.